new data out today reinforces the pressure on households, and the Royal Commission got deep and dirty into the bounds of lending obligations. Hello again. I'm Martin North, Principal Analyst at Digital Finance Analytics. We start with today's discussions at the Royal Commission into Banking Misconduct. CBA was asked about a case study where a gambling credit card holder ended up with a very large $35,000 debt. But it begged a broader question, which is, what should be the limits of a bank's responsibility, and how much responsibility should a borrower take for their financial affairs? The point is, there are things a bank could do with regard to transaction data matching and analysis, but where is the line between appropriate analysis and taking responsibility away from a customer, bearing in mind that individual cases may vary? This is important because sometimes it is not possible to draw a standard line in the sand.
The rubric is that depending on the circumstances of the customer and kind of credit contract, let's confine it therefore, depending on the circumstances of the consumer and a credit card contract, reasonable inquiries, the guide says, could also include other expenditure that may be discretionary, such as entertainment, takeaway food, alcohol, tobacco, gambling, all of them perfectly legal activities. So my question comes to, can the bank do anything? The second part of the question you will foresee is, should the bank do anything? But let's stick with, can the bank do anything to identify whether the customer that is either being offered or is seeking a credit limit increase has a spending pattern that shows that at least up till now he or she has been spending large sums on entertainment or takeaway food or alcohol or tobacco or gambling or all of the above or some combination.
Yeah.
Now, can the bank identify that?
Yeah, Commissioner, it's in many cases, yes, but not always, because scenarios exist where a customer could have a credit card with us and a transaction account with another bank.
Sure.
They could draw down on their credit card from our side and make a cash advance and transact in the other bank. We wouldn't know what they're using that cash for. They could...
Finish.
So I think, I don't want to try and get cute or anything, but, you know, clearly we can do these things and have, as I said, implemented some changes which do try and identify significant cases where customers are gambling a lot. But it is always going to have gaps. Or I say always, certainly as we sit here, there are gaps and loopholes in that because customers can move money between accounts. There are also complexities about not always knowing who a merchant is because descriptors aren't always clear. Customers can use cash and go and spend money on pokies. We would never know that either. So, you know, I think with limits, yes, we can. Ought we to? The second part of your question. I suppose that's a question of interpreting that guideline in RG 209.
Then there comes a question of law, and
Yeah.
I don't want to take you down the point of you offering legal opinions about
Yeah,
it,
exactly.
certainly if you're
Yeah.
uncomfortable.
If you sort of go back to the National Credit Act, which is all about making reasonable inquiries,
Yeah.
which is what the law says, and I don't like to sort of rely too heavily on the scalability argument, but it is a reality because the guidelines do say scalability, you've got to have regard to the complexity of the facility, the size of the loan. From our point of view, you know, we receive upwards of 40,000 applications a month for credit cards, another 20,000 for CLIs. So what in those circumstances is it reasonable to expect us to do noting that the large majority of people who do use their cards for gambling, they're very occasional gambling spenders.
And therefore, rather than that rather complex set of inquiries, does the inquiry become simpler and more relevant as saying that the bank as lender should look at least its own records to see the comparison between money in and money out?
This is a messy reality of banking, and black letter law approaches just won't work. Now let's look at the data that has come out today. First, the latest ABS data on employment for February is out. It's a mixed bag. On the positive side, employment increased for the 17th consecutive month, extending the record set in January, with full employment surging by 64,900 and overall over the past year having jumped 420,000, the second highest level over a 12-month period on record. Most of it was full-time employment. In addition, total hours worked also rose by 21.2 million hours, reversing much of the weaknesses seen in the prior 2 months, while the labour force participation rate, measuring the proportion of Australians' working age population either in or actively seeking work, ticked up to 65.7%, the equal highest level seen in 7 years. However, despite the growth in employment and hours worked, the seasonally adjusted unemployment rate rose from 5.5 to 5.6%, moving further away from the 5% level many people believe unemployment needs to fall below before wages pressures start to accelerate. In addition, the broader measures of excess capacity in the labour market, such as underemployment and underutilisation, also edged higher, casting further doubt as to whether wage growth will pick up gradually in the years ahead, as the RBA is hoping. The preferred monthly trend unemployment rate remained steady at 5.5% in February, and over the past year, the states and territories with the strongest annual growth in trend employment was the ACT at 4.7%, Queensland at 4.6%, and New South Wales at 3.9%. Next, the Federal Reserve in the US lifted the US benchmark rate as expected today. The so-called DOTS chart also shows more rate rises to come, up to 8 lifts over the next 2 years, which would take the Fed rate to well above 3%. The supporting data shows that the economy is running hot and inflation is expected to rise further. This will have global impact. The era of low interest rates is ending and the quantitative easing experiment is also over, but the debt legacy will last a generation. To underscore the potential rise in rates, here is a plot of the Aussie dollar bill versus OIS swap rate, a critical benchmark for bank funding. In fact, looking over the past month, the difference or spread has grown by around 20 basis points, and it's independent from any expectation of an RBA rate change. As a result, there is increasing margin pressure on the banks. In the round, you can assume a 10 basis point rise in the spread will translate to a 1 basis point loss of margin within the bank, unless banks reduce yields on deposit or lift mortgage rates. Now, individual banks are placed differently, with ANZ probably most insulated thanks to their recent capital initiatives, and Suncorp the most exposed. And in fact, Suncorp has already announced that variable owner-occupied principal and interest rates will rise by 5 basis points, and variable investor principal and interest rates will increase by 8 basis points, and variable interest-only rates will go up by 12 basis points. Suncorp's variable small business rates will also increase by 15 basis points, and Access Equity, the line of credit, rates will be increased by 25 basis points. The bank's CEO David Carter said the decision to increase rates is based on increasing cost of funding, as well as meeting the costs associated with regulatory change. The outlook for US interest rates factored in the decision as well. As a result, we have seen the key base cost of funding being the 3-month bank bill swap rate rise approximately 20 basis points. This increase results in higher interest costs for our wholesale funding, as well as our retail funding portfolio, such as term deposits, he said. Have no doubt, rates from here on in are on their way up. Next, the January 2018 data from the Standard & Poor's Performance Index (SPIN) for Australian prime mortgages increased to 1.3% from 1.07% in December. The report also found that no area was exempt from the increase, with loans in arrears by more than 30 days increasing in January in every state and territory. Western Australia remains the home of the nation's highest arrears, where loans in arrears more than 30 days rose to 2.44% in January from 2.08% in December. And that's reaching a new record high. Conversely, New South Wales continues to have the lowest arrears among the most populous states at 0.98% in January. Improving employment conditions will help keep defaults low, they said, but rate rises will have an impact on borrowers. The prudence of loan underwriting standards, particularly debt serviceability calculations, they say, is fundamental to how well borrowers absorb these higher costs. And they made 3 specific points. First, as lending standards for interest-only loans were less stringent before 2015, interest-only loans underwritten before then could be more susceptible to repayment shock when the loans roll into an amortizing repayment structure. Next, apart from the obvious risk of having less equity built up in the home, which increases the risk of loss in the event of borrower default, borrowers with high loan-to-value loans are also more likely to find it harder to refinance their home loan with another lender. And that's a common way for borrowers to manage their way out of financial stress. And finally, borrowers with less of a buffer to service their mortgages are more likely to experience financial stress when interest rates rise or their economic circumstances change. The integrity of debt serviceability standards is important in ensuring that debt-to-income serviceability assessments reflect each borrower's actual income and expenditure patterns. Now, of course, the recent discussions in the Royal Commission underscored these issues and pointed out that many loans would fail those standards. So, with interest rates rising, funding under pressure, and defaults rising, how are households reacting? Well, the latest edition of the Digital Finance Analytics Households Finance Confidence Index, released today, shows a further drift lower, remaining below the 100 neutral benchmark. It fell to 94.6 in February, down from 95.1 the previous month. This is in stark contrast to the improved levels of business confidence, as some others have reported. Now, by way of background, these results are derived from our household surveys, averaged across Australia. We have 52,000 households in our sample at any one time, and we include detailed questions covering various aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover a number of different dimensions. We start by asking households how confident they are feeling about their job security, whether their real income has risen or fallen in the past year, their view on their costs of living over the same period, whether they have increased their loans and other outstanding debts, including credit cards, and whether they are saving more than last year. Finally, we ask about their overall change in net worth over the past 12 months. And by net worth, we mean assets less outstanding debts. The slide was most significant amongst those households with investment properties, thanks to higher mortgage rates, concerns about interest-only loan resets, and lower home prices. In addition, net rentals were also lower. Owner-occupied households also fell just a small amount, mainly because of rising living costs against flat incomes. And those renting or otherwise excluded from property are the least confident. Now, this continues the long-term trend, indicating that property ownership still bolsters confidence to some extent. The slide was pretty consistent across the states, other than there was a small lift in Western Australia. Compared with a year ago, confidence levels in New South Wales and Victoria are significantly lower. We also see a similar story across all the age bands, suggesting the decline in confidence is similarly widely spread. To understand the reasons for the falls, we can look at the index scorecard. Overall, there was a rise of 1.2% in households feeling less secure about their jobs, compared with this time last year, and a small reduction in those feeling more secure. Those with savings were less comfortable thanks to continued falls in deposit rates and recent discussions about deposit bail-in following the passage of the recent APRA Act. More significantly, there are more households dipping into their savings to maintain lifestyle, and so their savings balances are reducing. And many realise that this is not a sustainable position. Just under half of households remain uncomfortable with the amount of debt they hold. Around half saw no change over the past year. Concerns related to rising interest charges, which are working through, and also their ability to maintain mortgage payments. Some households have resorted to obtaining additional credit, either on a card or by way of separate loan, to maintain their finances. Again, many realise that this is not a sustainable position. Costs of living concerns rose, with 76.7% up 3.84% over the last month. Households are saying that costs of electricity, fuel, rates, childcare and school fees are all impacting. Only 2.5% of households said their costs had fallen. Finally, we saw a fall of 3.7% of households who said their net worth had improved, down to 54.6%, mainly explained by changes in the value of property on one hand and share prices on the other. 16% said that their net worth had fallen, and 28.9% said there had been no change. So based on our research, we see little on the horizon to suggest that household financial confidence will improve anytime soon. We expect wages growth to remain contained and home prices to continue to slide while the costs of living pressures continue to grow. There will also be more pressure on mortgage interest rates as funding costs rise, as we discussed earlier, and lower rates on deposits as banks trim these rates to protect their net margins. We will update the results again next month. But if you put all of this together, we are forced to conclude that the pressure on households will continue to grow, and this explains why economic activity is lower and home prices are on the slide. We continue our journey into uncertain territory. If you found this useful, please do like the post and add a comment or question. I do read them all. If you have already subscribed, thank you. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.